There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today we're going to talk about trading, actually trading and understanding what's going on while you're trading a stock. A lot of people nowadays use trading stocks as a means of getting more monthly income. Most people want more monthly income than they can earn from wages or salaries. There is a ceiling on most everyone's wages and salaries, and a lot of people feel like the middle class is declining and they don't have a fair shake, or that they aren't able to get ahead. Well, this is a means of doing so, is trading the stock market. Trading the stock market is totally different than long-term investing. Long-term investing, you buy the stock and plan to hold it for several years, waiting for the price to move up and increase your return on investment. Short-term trading takes advantage of the daily and weekly activity of prices that move up and down for a variety of reasons. And if you learn to short-term trade, you can make extra monthly income. Now, when we talk about trading the stock market, new investors and new traders will immediately think it's day trading. Day trading is actually not that successful for most people. There are fewer professionals that day trade than ever before. They actually do different types of trading. So there's a lot of promotions about day trading, and here's why. Retail brokers make an enormous amount of money when you day trade. They're not particularly interested, or do they care, whether you actually make a profit or not, and that may seem strange to you, but if you lose all your money and give up and leave the brokerage firm, there's somebody else to take your place almost immediately. There's always new people coming in and wanting to learn how to trade, and they make an enormous amount of money. Brokers make a ton of money off of the retail traders and the retail investors. So you have to be wise and savvy and see the brokers as not your best friend or something that you can trust or rely upon. They are a vendor. They're selling you a service, and you need to be constantly aware that they may not have your best interest in mind, or they may not even care. They're just selling a service, and you're one of millions of people that they have that are using their brokerage account. Day trading is inordinately higher risk. It takes more capital resources, and you'll find that most brokers actually nowadays, since they've been burned by day traders who are using margin, that you need to have a certain level of education and understanding to actually day trade. There are also a lot of rules to day trading that are very specific and very difficult. There are many different types of trading styles, and short-term trading can generate a lot of money. How much can you make? Well, what we do is we don't do percentages, because percentages are very, very deceptive, and they create emotions. And the whole idea of learning to trade stocks is to do it with a very logical, very technical approach that ensures that you're not doing it emotionally. One thing I wanted to talk about today was that you can't buy stocks on an impulse. I have a lot of people coming to me for advice right now, and new people interested in the stock market, and everybody's saying, oh, you got to get in the market, you got to get in the market. And these people are very confused. They don't know anything about the stock market. They have learned very little about it. A lot of it sounds really scary. They don't know where to begin. They don't know where to get good information. The internet is just full of stuff, and they can't tell whether it's good or bad. And they're very nervous about it. And that's a good thing to be if you're brand new, to be a little nervous. You never want to buy a stock on impulse. You never want to buy a stock because somebody says, oh, this is going to go up, or Warren Buffett bought this, or whatever. And then you race to buy the stock without considering, thinking, oh boy, I'm going to make lots of money on it. You're going to lose money. So the first rule of trading or investing is Never buy a stock on impulse. Never buy a recommended stock unless you've thoroughly checked out everything there is to know about it. Just because it's recommended doesn't mean squat. Just because somebody bought it doesn't mean anything, because they often buy it and they drive the price up, and while the price is moving up, they're selling. So you have to be careful. The stock market is not more dangerous. The stock market doesn't have more evil guys or bad guys or criminals or fraud than other types of businesses. It's just that it's your money, and it's very glaringly obvious when you lose it. And other scams and things are not as commonly promoted on the internet. Anytime there's a scam or a fraud or a Ponzi scheme, the internet just goes wild with it, because they know everybody will read that article, because they're all thinking that the stock market's evil and awful. The stock market is the business of businesses. It's where people transact the business of buying and selling shares of a company. You can buy shares of a company as a long-term investor and hold for an extended period of time, or you can trade that stock among other traders. Another misnomer is that if you buy a stock and the price goes up and then you sell it, somebody is going to lose money. It doesn't work that way. There are 4 different trades that can be going on in a stock at any one time at the same moment. There can be buyers intending for the stock to go up. There can be sellers selling for profits. Both are going to make money, or have made money, or will make money in that instance. Then there's sell shorters, people who are selling the stock short. That's legal, and there's a reason why that's legal, is because when it comes time for other people to sell, if there's panic or a lot of people want to sell a stock, the sell shorters will buy to cover, meaning they will offer out a liquidity to keep the stock market rolling. When you don't have selling short, the stock market will crash, or the government will have to come in and shore it up like they did in China, because they don't allow selling short over there. When the stock market starts crashing, and it crashed dramatically, you should see the stock chart on that one a few years ago, the government had to literally come in and buy all kinds of shares of stocks of their companies. Well, now the government owns these corporations, not the everyday individuals in China. So at any one time, there's a buyer buying long, there's someone selling to close a position, there's someone selling short, which is an open position, intending the stock to go down, and there's buy to cover, those who are closing a sell short position. At any one time, all of those different trades could be making money or will make money. Just because someone is buying and someone is selling doesn't mean the person selling is losing money. They may be selling for profit. Someone who's buying may be buying and waiting for a number of weeks or months and will make money. Somebody who's selling short may be selling into the selling for profit and quickly buy to cover and make a little bit of money on that end. So every single one of those positions could be making money. This idea that when somebody loses money and somebody makes money comes from the casino concept. One thing to remember, the stock market is not a gambling casino. It's the business of businesses where people conduct the business of trading stocks or selling stocks or buying stocks. It's not a casino. A casino is a place where the house owns all of the assets, and they have dealers, and the dealers play games with the players. And usually the house or the dealer wins most of the time. And once in a while, players will win, but most of the time they don't. That's not how the stock market is. The stock market isn't a casino where there's a house and only the house makes money and everybody else loses money. That's not how it works. There are all different kinds of market participants, as we've discussed in other radio shows. There's 9 different market participant groups. And within those groups, there's different factions and different levels of expertise and experience. And every single one of those can be making money. If they know what they're doing and they do it right, they're going to be making good money in the stock market. So you got to set that concept aside, because that really hurts a lot of people. And it really makes them not understand what's going on. If you want to trade stocks to make extra monthly income, you have to view it as an open market where people offer to sell their stock and people bid to buy the stock. And so there's different variables going on all the time in the stock market. And you could be buying shares of stock from an institution who has a very large lot to fill. You could be buying a stock from somebody who's decided to sell their long-term investment. You could be buying a stock from a short-term trader. There's all different variables. It's not a house or a casino, and this gambling concept really hurts the stock market, and it hurts most beginners because if they view it that way, then they're going to gamble. The last thing you want to do is an impulse buy. You should at least decide whether you're going to be a fundamentalist or a technical analyst or a relational analyst, because you have to decide what you're going to do as far as trading and investing. If you're going to be doing long-term investing, then you have to look at the fundamentals as well as the technicals. If you're going to be a short-term trader, in a lot of instances, you'll find everything you need to know about that stock and that short-term trade in the technical analysis. If you're going to be doing more sophisticated trading and making a living from the market, then you'll want to go to relational technical analysis, which is what we teach. We're the only company that teaches it. And it combines all of the factors of technical, fundamental, quantitative, and risk analysis all in the stock charts. So instead of having to go and read a balance sheet or a profit and loss statement, you look at the charts and it tells you what's going on. That's what separates TechniTrader from every other company out there that sells education. And in particular, your online broker's education, which is very rudimentary, outdated, old stuff that they just gathered from the internet and they offer it to you for free. It's not going to help you learn to trade. I can always tell when someone who is supposedly teaching how to trade stocks, whether or not they've actually traded stocks or not, just by the stocks that they pull up and the charts they pull up and they show when they're demonstrating in a seminar or webinar or whatever, because it's pretty obvious whether someone's actually trading or not. There's certain setups and certain patterns that are going to be very successful for traders, and then there's others that are not. Just because a candlestick pattern shows doesn't mean that that's a buy signal. There are reversals and continuation patterns and dozens of them taught in the old style candlestick books, but not every one of those is a buy signal or a sell signal. A reversal pattern may not be a buy signal or a sell signal. And that's something that you have to learn. You need to be aware that you want to always buy a stock with logic and discipline. And what is discipline? Discipline is the ability not to get emotional about anything. You look at a chart, you see it's got the proper setup, you check the risk-reward ratio, you check your potential profit point gain potential, and when it all lines up in a very logical format without any emotion, you know that you can buy that stock and it will be a successful trade. The problem with most retail traders is everything is emotional. Oh, they hear it on the social media. Oh, somebody told them to buy this stock. Oh, the guru is buying the stock, so I need to buy it. And you're all buying on impulse. And that will mean that you're going to lose money because you have no idea what the risk factors are, what the profit potential is, and what you expect that stock to do and why. Who's trading that stock? Who's investing in it? Who's buying that stock? Who's selling it? You have to know that information if you want to be successful trading stocks. So it's not about one specific candlestick or one indicator or a broker recommendation or whatever. It's understanding the dynamics of what's going on in that stock right now, looking at the technicals and the technical analysis and the new fundamental indicators that are now available in stock charts as well. That takes a whole lot of guesswork out because instead of having to go to the balance sheet or income statement or EPS or anything like that or all the little numbers, alphas and betas, all you have to do is look at the chart and it tells you, oh, earnings last month went down. Oh, revenues went up. Well, that's an anomaly. Or vice versa. Right now, a lot of companies have lower revenues but higher earnings. Now, how is that possible? It actually is not. Revenues going down would mean that they would not have as high earnings if it was properly expressed. A lot of times, a CFO will take an expense and they will push it to the balance sheet as an asset. And therefore, they will lower their expenses when revenues are lower. And this is legitimate general accounting principles. It can be done legally. And so earnings are higher when revenues are lower. So if you earned less money last month on your wages or salaries and your expenses stayed the same, but you wanted to go to your bank and you wanted to make your bank see that you were doing better, you could basically take that expense and say it's an asset and not an expense, and all of a sudden your net earnings would be higher. That's what they do. They do it all the time. So what you have to do is not just look at EPS. EPS is pretty worthless unless you look at revenues and compare and see that revenues went up and earnings went up. And you can do this all on the stock charts. You don't even need to go to the fundamentals at all. It's all there in the charts now. That's the modern charting software, and I can assure you that your broker doesn't have that. So without that, you're working in the blind. You don't really know what's going on. And even in short-term trades, there are times when you really do need to know that, and you need to know it quickly, just by looking at a chart and going, okay, earnings are down, earnings are up, revenues are down, revenues are up, and a plethora of other fundamentals that can now be in a chart with line charts for fundamentals. So it's a brave new world out there with charting software. There's a whole lot more that is in the charts that you can analyze and really study stocks. And some people say, oh, I'm just technical. I'm strictly a technical analyst. Well, what do you think technicals are? They're an expression of the fundamentals of that stock, of that company. They're expressing the value that the dark pools and the giant institutions have placed on that stock. The technicals are simply a graphical form of what's been going on in the company. And if you study those, you will be able to understand whether the company is getting more successful or if its business cycle is peaking. Business cycles go up and down. Businesses just don't grow and grow and grow and grow. At some point, they correct. Some businesses have 3-year cycles, some have 7-year cycles, some have 10-year cycles, some have 12-year cycles. Some cycle every year. And if you get to know this and understand this from the technical analysis, and what I teach, which is relational technical analysis, which encompasses more information into the stock charts, you will thoroughly understand what you're looking at, and you will make better buy decisions and sell decisions, whether you long-term invest or short-term trade. So visit our website, check us out and see what's going on, because we have education that you will find nowhere else. And we are educators. Not everyone can teach. And just because someone is really good at something doesn't mean that they can teach you how to do it. The combination of our experience and our expertise, and having been teaching since 1998, and our educational backgrounds and our extensive experience with technical analysis, fundamental analysis, and risk analysis into a relational analysis is unique. It's what separates TechniTrader from every other educational company. So come visit us, go to our courses page, watch the video. You don't have to register for it. You can just watch the video. If you like what you see, give us a call or download the course syllabus of your choice and check out and see what we have. I'm Martha Stokes, and until next week, invest and trade wisely and logically, without emotions and without impulse buys.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.